Hey everyone, and welcome to your options education station. Today, we're diving into a strategy called covered calls. It's a popular choice for investors who want to squeeze more out of their stock holdings. But here's the thing, covered calls can be a bit mysterious. Are they just for fancy traders? Can they really help you make money in any market? We'll break down exactly how covered calls work, from the basics to the nitty-gritty. We'll see if they're a better fit than just buying and holding stocks, and answer the burning question, are covered calls too complex for beginners? Stick around, and by the end of this video, you'll know if covered calls are the secret weapon you've been missing in your investment toolbox. Are covered calls better suited for short-term or long-term holding periods? Covered calls are generally better suited for short-term holding periods rather than long-term ones. Here's a breakdown of why. Benefits of covered calls. Income generation. The main advantage of covered calls is the premium you receive for selling the call option. This premium boosts your total return on the stock, even if the stock price stays flat or goes down slightly. Drawbacks of covered calls. Limited upside potential. If the stock price rises significantly above the strike price of your call option, you'll be obligated to sell your shares at the strike price, missing out on the additional gains. Time decay. The value of the call option, and the premium you receive, deteriorates over time as it gets closer to expiration. How these factors impact holding periods. Short-term. In a short-term holding period, the time decay is less impactful. You can capture the premium income while limiting the potential downside if the stock stays flat or dips slightly. If the stock price shoots up unexpectedly, you may miss out on some gains, but the holding period is short, so the foregone profits might be smaller. Long-term, the time decay becomes a more significant factor over a longer period. You'll keep collecting premiums, but the overall benefit might be eroded by the decaying value of the options. Additionally, if you're bullish on the stock long-term, capping the upside potential with covered calls might not be ideal. You want the stock to appreciate in value if you have a long-term perspective. Here's an analogy. Think of covered calls like selling tickets to a concert. The concert stock price might sell out, go up significantly, and you'd miss out on the higher profits from selling your tickets, shares at a higher price. But if the concert doesn't sell out, stock stays flat or dips, you at least made some money from selling the tickets, premium. This analogy works better for shorter events, concerts, where time decay isn't a major factor. Overall, covered calls are a strategy for generating income and potentially hedging some downside risk. They are most effective when used strategically for shorter periods where the time decay is less severe and the potential missed upside is limited. For long-term holdings, where you believe in the stock's appreciation potential, covered calls might not be the best fit. Additional factors to consider. Market volatility. Covered calls can be beneficial in a volatile market as they provide some downside protection. However, high volatility can also lead to higher option premiums, making covered calls more attractive. Interest rates. Rising interest rates can make covered calls less appealing as investors can earn a better return on less risky investments like bonds. Can covered calls be used with dividend-paying stocks? Yes, covered calls can be used effectively with dividend-paying stocks, and in some cases, they can be a particularly good fit. Here's why. Benefits of combining covered calls with dividends. Enhanced returns. Covered calls generate income from the premium received when selling the call option. This income stream adds to the overall return you get from the stock, which already includes the regular dividend payments. Potential downside protection. If the stock price stays flat or dips slightly, you still collect the premium, mitigating some losses. Reduced impact of ex-dividend date. The ex-dividend date is the day after which new stock purchasers are no longer entitled to receive the upcoming dividend. Since you already own the shares when selling covered calls, the stock price drop on the ex-dividend date has less impact on you. You've already collected the dividend and may even benefit slightly from the price decrease, as it can make the call option slightly more valuable. Intrinsic value. Things to consider. Reduced upside potential. As with any covered call, if the stock price significantly exceeds the strike price, you'll be assigned early or be forced to sell at the strike price, missing out on the higher gains. This becomes a trade-off between guaranteed income from the premium and potential for higher capital appreciation. Call option selection. When using covered calls with dividend-paying stocks, you might want to consider choosing a strike price slightly above the cost basis of your shares. This allows you to capture some potential upside while still being profitable even if assigned early, due to the premium income and the previously collected dividend. Compared to dividend ETFs, do covered calls offer higher or lower potential returns? The potential returns of covered calls compared to dividend ETFs depend on several factors, and both have their pros and cons. Covered calls. Pros. Potential for higher income. Covered calls generate income from selling call options, which adds to the return from any stock price appreciation. Downside protection. Covered calls offer some buffer against a decline in the stock price since you collect the premium income. Cons. Limited upside potential. If the stock price rises significantly above the strike price, you are obligated to sell your shares at the strike price, missing out on further gains. Time decay. The value of the call option, and the premium received, deteriorates over time as it gets closer to expiration. Dividend ETFs. Pros. Diversification. Dividend ETFs provide exposure to a basket of dividend-paying stocks, reducing company-specific risk. Capture both dividends and capital appreciation. You benefit from both the dividends paid by the underlying stocks in the ETF and any potential price increase of the ETF itself. Cons. Lower potential income. Dividend ETFs typically offer a lower yield compared to the income generated from strategically implementing covered calls. Less control. You don't have control over the specific stocks within the ETF or the option strikes used in a covered call strategy. Here's a breakdown of how the factors can influence returns. Market volatility. High volatility. Covered calls can be more attractive in a volatile market due to the premium income, while dividend ETFs might experience price fluctuations. Low volatility. Dividend ETFs might be preferable in a low volatility market as they provide steady income from dividends and potential for capital appreciation. Stock price direction. Rising market. Dividend ETFs benefit from both rising stock prices and dividends, while covered calls limit upside potential. Flat or slightly down market. Covered calls can generate income from premiums and potentially mitigate downside risk, while dividend ETFs might see lower returns. In general, covered calls have the potential for higher returns if the stock price stays flat or increases moderately, but they limit profits in a strong bull market. Dividend ETFs offer more consistent returns through a combination of dividends and capital appreciation, but they may underperform covered calls in specific market conditions. Are covered calls more complex than simply buying and holding a stock? Yes, covered calls are generally considered more complex than simply buying and holding a stock. Here's a breakdown of why. Buying and holding. This is a relatively straightforward strategy. You purchase shares of a stock you believe will appreciate in value over time. You then hold on to those shares, hoping for a price increase and potentially collecting dividends if the stock offers them. The main factors to consider are choosing the right stock based on your research and risk tolerance, and then having the patience to hold on to it through market fluctuations. Covered calls. Covered calls involve an additional layer of complexity. You not only buy a stock, but also sell call options on those same shares. Here's what adds complexity to covered calls. Understanding options contracts. You need to understand how options work, including factors like strike prices, expiration dates, and option Greeks, delta, theta, vega, and rho. Selecting strike prices and expiration dates. Choosing the right strike price and expiration date for your call options significantly impacts the potential income and risk profile of the strategy. Monitoring the options contract. The value of the call option you sell constantly changes based on factors like the stock price, time decay, and market volatility. You need to monitor the option and potentially adjust your strategy as needed. Here's an analogy. Buying and holding a stock is like buying a house and holding on to it. It's a simple concept, but the value of the house can fluctuate based on market conditions. Covered calls are like buying a house and then renting out a room with specific terms, strike price and expiration date. There's additional complexity in managing the rental agreement, option contract, on top of the underlying value of the house, stock price. Additional factors that increase complexity. Market volatility. Covered calls can be more challenging to manage in a volatile market as option prices fluctuate more significantly. Rolling covered calls. An advanced strategy involves rolling your covered calls, which means buying back the original call option and selling a new one with different strike prices or expiration dates. This requires a deeper understanding of option strategies. Overall, while covered calls offer the potential for higher returns than simply buying and holding, they come with additional complexity. If you're new to investing, it's wise to gain a solid understanding of options before implementing covered calls. There are many resources available online and from brokers to help you learn about options trading. Who might benefit from using a covered call strategy? Several types of investors can benefit from using a covered call strategy, depending on their investment goals and risk tolerance. Here's a breakdown of some ideal candidates. Income-oriented investors. Covered calls are a great way to generate income on stocks you already own or are willing to hold. The premiums received from selling call options provide a steady stream of income, which can be particularly attractive for retirees or investors seeking to supplement their income. Conservative investors. Covered calls offer some downside protection. Even if the stock price dips slightly, you still collect the premium, mitigating some losses. This can be appealing to risk-averse investors who want to partially hedge their holdings. Neutral investors. If you believe a stock price will stay flat or rise moderately in the near term, covered calls can be a good way to generate income without sacrificing significant potential capital appreciation. You collect the premium while still benefiting if the stock price increases modestly. Investors with a long-term bullish view on a stock, with limitations. Even if you're bullish on a stock long-term, covered calls can be used strategically. You can choose a strike price and expiration date that allow you to capture some upside potential while still generating income from the premium. However, be aware that covered calls limit your potential profits if the stock price significantly exceeds the strike price. Here are some additional factors to consider. Tax implications. The qualified dividends received from the stock may be taxed at a lower capital gains rate compared to the ordinary income tax rate on option premiums. This can be a tax advantage for covered calls. Investor experience. Covered calls are not suitable for beginners due to the complexity of options. It's crucial to understand options mechanics and potential risks before implementing this strategy. Who might not benefit from covered calls? Aggressive growth investors. If you're looking for maximum capital appreciation and are comfortable with higher risk, covered calls might not be ideal. They limit your upside potential. Short-term traders. Covered calls are typically used for holdings with a short-term to medium-term time horizon. They might not be suitable for short-term trading strategies. Are there any costs associated with covered calls, besides the purchase price of the stock? Yes, there can be a few costs associated with covered calls, besides the purchase price of the stock itself. Here's a breakdown. Commissions. Most brokers charge commissions for both buying and selling options contracts. These commissions can eat into your overall profits from the covered call strategy. Some brokers may offer lower commissions for options trades or commission-free options trading entirely. Margin requirements. While covered calls are a relatively conservative options strategy, some brokers might require a margin deposit when selling options. This is essentially a cash cushion to ensure you can fulfill your obligation if the option is exercised. Buyer calls away your shares. The margin requirement will vary depending on the broker, the stock price, and the strike price of the call option. However, in a true covered call, where you already own the stock, many brokers will waive the margin requirement. Bid-ask spread. The bid-ask spread refers to the difference between the price you can buy an option, ask price, and the price you can sell it for, bid price. When selling a call option, you'll receive the bid price, which is slightly lower than the ask price. This difference represents the market maker's fee for facilitating the trade. Minimizing costs. Selecting a broker with low commissions or commission-free options trading can significantly reduce your costs. Understanding margin requirements. Ensure you have sufficient funds available to cover any potential margin calls if your broker has them for covered calls. Being mindful of the bid-ask spread. Consider the spread when choosing strike prices to ensure the premium received outweighs the difference between the bid and ask price. Additional factors to consider. Taxes. The premiums you receive from selling call options are generally considered short-term capital gains and taxed at your ordinary income tax rate, which can be higher than the capital gains tax rate on stock sales held for longer than 1 year. Time investment. Monitoring and potentially adjusting your covered call positions require some time and effort. How does the selection of the strike price impact a covered call? The selection of the strike price for a covered call significantly impacts several factors in your overall strategy. Here's a breakdown of how the strike price influences your potential returns and risks. Impact on profit potential. Higher strike price. Pros. You'll receive a higher premium when selling a call option with a higher strike price. This is because the buyer of the option is taking on less risk by having a higher price point to exercise at. Cons. You limit your potential for capital appreciation from the stock. If the stock price rises above the strike price, you'll be assigned early, forced to sell your shares, or miss out on profits by selling at the strike price when the option expires. Lower strike price. Pros. You capture more upside potential if the stock price increases significantly. You won't be assigned early as easily, and you can potentially benefit from selling your shares at a higher market price. Cons. You'll receive a lower premium when selling a call option with a lower strike price. The buyer perceives this option as having a higher chance of being exercised, so they are willing to pay less for it. Impact on risk. Higher strike price. Pros. Lower chance of assignment. The option is less likely to be exercised early because the buyer needs the stock price to rise considerably to make a profit. This can be beneficial if you're bullish on the stock long term and want to hold on to it. Cons. Reduced income generation from a lower premium. Lower strike price. Pros. Higher premium income. You receive a larger upfront payment for selling the call option. Cons. Higher chance of assignment. The option is more likely to be exercised early if the stock price goes up even slightly. This can force you to sell your shares earlier than planned, even if you're bullish on the stock price long term. Choosing the right strike price. The ideal strike price depends on your investment goals and risk tolerance. For income generation, if your primary goal is to generate income from the premium, you can choose a lower strike price to maximize the premium received, even if it comes with a higher chance of early assignment. For capital appreciation with some income, if you want some potential for capital appreciation while also generating income, you can choose a strike price at or slightly above the current stock price. This allows you to capture some upside if the stock rises and still collect a decent premium. For long-term bullish investors, if you're very bullish on the stock long-term, you might consider a higher strike price that allows you to potentially hold on to the shares for a longer period and benefit from significant price appreciation. However, the premium income will be lower. Alright, so that's the covered call strategy in a nutshell. Remember, covered calls are a great tool for income generation, potentially some downside protection, or strategically participating in a modestly rising market. But they're not magic bullets. Before you jump in, consider your investment goals and risk tolerance. If you're new to investing, it's wise to start with simpler strategies and build your options knowledge. There are tons of resources out there to help you learn more. If you're intrigued by covered calls and want to explore further, definitely check out the links in the description below. I'll also be uploading some follow-up videos, going deeper into different aspects of the strategy. Thanks for watching. Don't forget to like and subscribe for more options education content. Hit the notification bell so you never miss a video.